G'day, Si. This is a great question. What about tax when it comes to a family trust? Now, a family trust actually doesn't pay any tax. I'm going to run you through a little bit of a structure diagram to explain how a family trust can work as a business owner and how many people take advantage of the flexibility that a family trust provides in order to optimize their tax position. So let me flip the camera around. Okay, so when we're looking at a structure, we've basically got three components here for a business owner. So the first component is that typically a business runs through a trading company, and a trading company will pay a flat rate of tax of 25%. And that proprietary limited company basically allows us to isolate risk, and it gives us the opportunity to accumulate profits because a company does not have to distribute all of its profits every year. However, we've also got to be mindful that a company is one of the highest risk entities that we have, particularly a trading company, because that is what we're dealing with the public. So if we're going to get litigated, it's in many cases going to be through this entity. So usually what many of our clients do is they own the shares of their proprietary limited company by their family trust. And what this allows us to do is to have flexibility around future distributions. Compared to, let's say, for example, you own the shares in that company 100% on your own name, that means that you would need to receive 100% of the profits, which doesn't provide you with any flexibility. So a family trust gives you the ability, the discretion to choose how profits and capital gains are distributed each and every single year. So what then happens at the end of the financial year, we determine the beneficiaries and then we make distributions based on what is going to lead to the optimal tax outcome for that individual based on their individual tax rate. So let me just give you an example. So let's say, for argument's sake, we have a business that has $1 million in revenue, and to keep things simple, we've got $500,000 in profit. That business would pay $125,000 in tax at 25%, and that basically would leave it with a net profit of $375,000. However, this tax is what's referred to as a franked tax paid. It's a franked dividend that we can pay, which basically means that we have a $375,000 distribution. We have $125,000 for franking credit for tax that is already paid, which basically means we have a grossed up distribution of $500,000. Okay, so then we get down to John and Jane. Let's say that they have school-age kids, so therefore they can't distribute to those individuals, so they can only take the income themselves. So they do a $400,000 distribution. John gets 200 grand. He's going to pay 60 grand in tax at 30%. The reality is he'd only pay the top-up tax for 5% because the tax has already been paid at the company level. Jane would receive the other 200,000. She's going to pay the top-up tax as well. And let's say, for argument's sake, they have net income of 280,000 after tax. They've got household expenses of 200 grand, and they've got an $80,000 surplus. Now, what many of our clients also do is they add in a bucket company. And a bucket company is basically a corporate beneficiary because John and Jane are now at a 30% average tax. If we pay any more, they're going to pay a higher than 30% average tax because of the progressional tax structure that we've got. So what we end up doing is setting up a bucket company. We distribute the remaining 100,000 in there, and that has a flat rate of tax of 30%, which basically means that after that tax has all been paid, there's a $70,000 surplus that exists in that, and we will typically invest that into a portfolio, a share portfolio in this particular example of 70,000. And what we also do is the couple here have $80,000 in surplus, so we utilize that as a deposit to go and buy a $500,000 investment property inside this family trust. Now, let's say we do this for 10 years. So we've had $10 million in revenue, $5 million in profit. We've distributed $3.75 million, and we've got a franking credit there, so it's $5 million grossed up. John's at $2 million over that 10-year period of time and paid 600 grand in personal tax. So has Jane, and they've accumulated $800,000 in surplus over that time, and they've basically utilized that to build a $5 million investment property portfolio inside their family trust. They've also used their bucket company in order to distribute $1 million in surplus profits at a 30% tax rate, and they've used that to build up a share portfolio, not assuming any growth of 700 grand. But what they've now got is $300,000 in franking credits, which basically they can hold for time periods where they have lower than a 30% tax rate, and it actually means they're going to get a tax refund. So in a typical scenario of a business owner, what we're aiming to do is, first and foremost, we want to try and sell the business and utilize the CGT tax concessions, because essentially it allows us to sell a business for up to $6 million, in many cases completely tax-free depending on the client's age and circumstances. So let's say they sell the business for $2.5 million, they leverage those CGT concessions, they pay zero tax on that sale, and they can actually get all of that money into superannuation, meaning that from 60 plus, they're going to pay no tax on earnings and no tax on income, okay? So let's work through what this typically looks like. So let's say these individuals, because they've been maxing their concessional contributions, they've done the CGT small business concession of 2.5 mil. Let's say they've got $3.6 million combined in superannuation. They can draw $144,000 a year of tax-free income in this situation. Then the family trust now owns 5 properties worth $1 million each, and that produces $150,000 in passive income, which is distributed to John and Jane. And we've also got the ability to distribute from the bucket company $150,000. And because of their marginal tax rate, they're essentially not going to pay any additional tax. So this group of individuals would have a combined household income of $444,000. And if they've got any additional surplus, they can recontribute that back to the bucket company and utilize that to build generational wealth. And they're not going to have to pay any extra tax in retirement. So this is a hypothetical strategy, once again, not advice, but just to give you some context around how a family trust can be used, how a bucket company can be used, how superannuation and small business CGT concessions can be used in order to accumulate a significant amount of total wealth and be able to utilize the tax rules to your advantage. This does require specialist advice and will be specific to your situation. So if you want some help with setting this kind of stuff up, jump in my bio, click the link, feel free to reach out to me, and happy to have a conversation. Hope this is helpful.